Ray Dalio is, of course, one of the richest and most popular investors in the world, and he is also the founder of Bridgewater Associates, which is one of the largest hedge funds in the world, which currently holds over $120 billion of assets under management. Now, Ray Dalio has recently stepped down from the CEO position, but he was still the founder of Bridgewater, and he continues to serve it by overseeing their investment committee as well as serving as their senior advisor. So he still very much guides their biggest investment decisions. And speaking of which, those investment decisions were publicly released recently for their 13F filings, which shows us the biggest purchases and sales that Bridgewater made in the last reported quarter, which was the first quarter. This is the most up-to-date information that we have on Bridgewater. And so, as always, we'll be taking a look today at the top 5 largest purchases that Bridgewater made in the stock market in the most recently reported quarter. And for each of them, I'm going to share my opinion on each one, and I'll even rank them from best to worst based on my own opinion as well, just like we always do here on the channel. It's always a lot of fun to do these videos. I hope you guys enjoy this one as well. And if you want to support the channel, you just hit that like button. You can subscribe. If you want to go above and beyond, really help keep this channel alive, you can support me on Patreon, where you get a bunch of cool perks, including access to our own private community Discord where we can talk about stocks, and it's a lot of fun. So I hope to see you on there, but thank you so much for any support you give to the channel. And with that said, let's not waste any more time. Let's just go ahead and jump straight into this list of the 5 largest purchases Bridgewater recently made. All right, and counting down here from smallest to largest position in the portfolio, purchase number 5 was the biotech giant AbbVie, ticker symbol ABBV, which they had actually sold almost completely out of in the prior quarter, but have now purchased the most shares that they've ever held at close to 400,000 new shares, bringing the total stake in the company up to over $65 million. And yet, that's not even half of 1% of the entire portfolio. So it just shows you how massively large Bridgewater is. But anyway, this one here is interesting because it's actually a stock that I own myself too, and I am currently up on my position by over 100%. However, the public stock itself has actually been super volatile recently, and has even fallen by over 15% this year, leaving it now trading right near a 52-week low. So is this a good time to be buying the stock right now? Well, it's a little tricky because the stock has fallen for a couple different reasons. For one, it had already run up a lot right before this year's downturn, so a correction did make some sense here. But more importantly, the reason for that correction is because their best-selling drug Humira, which was the best-selling drug in the world, has now lost patent protection, which means AbbVie sales are expected to take a giant hit. In fact, what was recently a very high growth, financially dominant company is now expected to see their sales decline by almost a double-digit % this year before stabilizing the year after. Now, the good thing is that the bleeding is expected to stop next year, and then you should see the company return to healthy growth rates once again, thanks to all of the diversification that they really have. For example, over the long term, 2 of their blockbuster immunology drugs in Skyrizi and Rinvoq are expected to make up for the losses of Humira as they continue to gain new key indications, many of which actually overlap with Humira. On top of that, they've been building up other drugs too, like Venclexta, that recently showed long-term success as a cancer treatment. They also gained FDA approval over the past year for 2 key drugs in Vraylar for depression disorder and Qipta for chronic migraines. And their giant acquisition of Allergan from a few years ago has also made them a much larger, more diversified company that still has close to 100 more treatments in their pipeline for the future, with over 50 of them already in mid to late stage development. Meanwhile, the short-term pain has caused the valuation to sink quite a bit lower than the sector on a forward PE basis, while the dividend is still one of the most attractive out there at over a 4% yield with over 5 decades of consecutive growth, essentially making it a dividend king. Still, I would rank AbbVie somewhere in the middle for now at number 3, just because I'm not a fan of buying companies that are in decline. Again, I own the stock myself and I'm very much committed to holding it long term, but I also have a way cheaper cost basis on my stock than everybody else who would be buying it now. So it's not really fair for me to say that I'm super bullish on it since I have a much safer position than, most other people. And so therefore it's much easier for me to hold my stock long term, which is what I plan to do, not buying, not selling, just holding. So it'll get the number 3 ranking. Okay, moving on to stock number 4. We actually have another stock here that I own a large position in as well. In fact, it's actually my number 1 largest holding in my entire portfolio, and that is of course the almighty Microsoft, ticker symbol MSFT, which they had surprisingly sold almost entirely out of in the quarter before that, so they now increased their position by a gigantic 1,400%, bringing the total stake in the company up to almost $75 million. And this one too is a little tricky to grade at the moment because I pretty much always think Microsoft is a good stock to buy since the business is so incredibly strong with almost $200 billion in sales and over $70 billion in profits just last year alone, which is really good margins for their size. And the stock price itself seems to always have amazing performance and it rarely ever dips. In fact, I would say that last year was one of the absolute best buying opportunities that I've ever seen in the stock, as it was down around 30% for the year and even much more than that at certain times. But unfortunately this year it has already largely recovered with about a 40% run up so far year to date, leaving it now trading more expensive than the sector by around 50% or more on virtually any metric you look at. Now granted, I actually believe Microsoft deserves to trade at that premium price, which is why I'm still holding it as my number 1 largest stock for the long term. And I also love everything that they're doing as a leader in artificial intelligence, cloud computing, gaming, computer and productivity software, and so many other things. Plus, they even pay a nice little dividend with some excellent growth metrics on it. It's too small to be considered anything meaningful, but I'll still take it as a nice little bonus. However, at the currently high price, I'm just not looking to buy any more shares of the stock at this time myself. I will, however, rank it higher than AbbVie regardless though, as I still consider it to be significantly safer as a long-term investment, and it could easily be a core staple in pretty much anyone's portfolio, whereas I wouldn't really say the same thing about AbbVie, which is a bit riskier with the current turnaround phase that they're going through. So I'll put Microsoft at number 2, and I'll keep AbbVie at number 3. Oh boy, things are only going to get even more difficult to rank from here though, guys, as stock number 3 is yet another stock that I own myself too, and that is Meta, ticker symbol META, which they nearly doubled up their position on last quarter, bringing the total stake in the company up to over $200 million. Now, the stock itself used to be pretty stable back in the day, but in recent years, it's turned into an absolute roller coaster ride, especially in 2022, where it saw a gigantic crash of almost 80% from the top. And that was mostly due to their huge investments into the metaverse, which most people have been very skeptical of on how much that'll actually benefit them over the long term. But despite that, the stock has actually seen a gigantic rebound this year, climbing 140% year to date. Although from its highs of almost $400 a share, Meta still trades about $100 cheaper than where it used to be at back then, and it's at less than $300 today. And because of that mixed performance, the valuation is also a bit of a mixed bag as well, as it is significantly more expensive than the sector on a forward PE basis, but actually 21% cheaper on a more forward-looking PEG, price to earnings to growth ratio basis. And what that tells me is that analysts are just expecting Meta to perform much better over the longer term, many years out into the future. And yeah, that actually makes perfect sense to me, as sales were exploding during the pandemic, but then actually declined last year when that lockdown fueled growth ended, and they were left spending huge amounts of money on building up the metaverse, with even this year still sitting at a single-digit growth rate. However, next year, it's expected to recover back up to a double-digit growth rate, with EPS growth also improving to almost 20% per year over the next 5 years, which is up from only 7% growth in the previous 5. And again, that's in large part due to the future potential of AI and the metaverse, which the metaverse alone is expected to grow by a whopping 70% per year through 2027, reaching a mind-blowing $3.4 trillion, if you can believe it. And the broader AI market is also expected to add over 15 trillion to the global GDP by 2030. And so Meta is building supercomputers and all the hardware and software needed to really be one of the earliest adopters of all these technologies and be one of the biggest leaders of that market, especially the metaverse. And that's why future projections are so high, since even without the metaverse, Meta is still a social media empire with giant profits, doing a mind-blowing over $50 billion of operating cash flow in just the past year alone, and an equally gigantic user base of around half the entire world's population that can all be marketed to for the metaverse as well. So overall, there's really a lot to like and be optimistic for. However, I would still be very cautious with this one, as the stock price is now higher than the average analyst price target, and the future of the metaverse is still one of the most highly debated topics out there. And because of that, I still think it's riskier than Microsoft, but a little safer than AbbVie, so I'll rank them right in between the two. I'll slide Microsoft up to the number 1 spot to fit Meta in right at that number 2 spot for now. Alright, now as if we didn't already have a bunch of very solid pickups, stock number 2 might actually be the best one of all of them. In the internet technology giant Google, ticker symbol GOOGL, which they increased a position on by over 200% last quarter, bringing the total stake in the company up to almost $240 million. And yeah, I think this one will have to take the top spot, guys, as they not only compete extremely heavily or just flat out dominate most internet-based markets like digital advertising, search, smartphone operating system, navigation, email, internet browser, social media with the gigantic YouTube. There's cloud computing. They have their own version of ChatGPT with Bard, and they're even building up their own ecosystem of products and services tied to their Pixel family that competes directly with Apple, which, don't forget, Apple is the highest valued company in the world at almost $3 trillion, with mostly just that family of products too. But on top of all that, I would also argue that the stock price itself for Google is more attractive really than the other stocks on this list that we've seen so far as well, as they are technically up over 30% this year like most other tech stocks. However, from the top, they're still down over 20% and trade almost 20% cheaper than the sector on a PEG ratio basis despite their market leading dominance. And a big reason for that is their super impressive growth that even at their already gigantic size, they are still expected to average close to 20% EPS growth over the next 5 years, despite already doing that in the previous 5 years as well. And they're even trading well below the average analyst price target to make it even sweeter. So even though Microsoft is my largest holding, I just think that at today's prices, Google is the more attractive pickup, and I'm going to have to give them that number 1 spot at the lead there and move everything else down 1 spot so that I can fit it in. Alright, and finally, that's going to leave us now with our final stock of the list. And coming in at stock number 1, the largest of these 5 holdings, is actually going to be an ETF. And that's going to be the iShares IEMG ETF, which they increased their position on by over 22%, bringing the total stake in the ETF up to over $17 million and over 5% of the overall portfolio. Now, if you're not familiar with these iShares ETF, the iShares brand is actually owned and managed by the giant behemoth known as BlackRock. And this one in particular happens to be one that tracks emerging markets, which has the goal of giving broad exposure to up-and-coming international countries like China, Taiwan, South Korea, India, Brazil, and so on, with some of the largest holdings including Taiwan Semiconductor, Tencent, Samsung, Alibaba, and more. Now, the ETF also has a really cheap expense ratio that is more than 80% cheaper than the median of all ETFs, which you probably would never even notice, especially considering the 2.3% dividend that you get in return for owning the ETF. And overall, I just think it's a pretty decent choice if you're maybe too afraid to go out and buy individual foreign stocks from emerging markets on your own, and you'd just kind of rather have a giant asset manager like BlackRock to do all of the stock picking for you in this particular scenario. However, for me personally, I'm just not the biggest fan of this one, and that's for a few different reasons. For one, the dividend isn't all that attractive with a negative growth rate. For two, it has way too much exposure to finance at over 22%. And while I'm okay with the heavy exposure to technology as the second and third largest sectors, I just think that it could be better balanced out with the rest of the sectors that only sit at around 5% or less. I would probably move some funds over from finance into those other sectors. I also think that the performance of the ETF isn't very impressive, as it's still about flat over the past decade and has a whopping 73% worse return than the median, which is pretty bad. But to top it all off, you guys know that I'm just not a very big fan of ETFs in general, because I actually enjoy handpicking my own individual stocks. So it'll have to go in last place at number 5 on the ranking chart. I can understand why some would want it, but it's just not something that I would want myself. So anyway, there you have it, guys. I ranked Google at number 1, which I think is the best overall option. Then I put Microsoft at number 2, who I think is a very safe, long-term kind of foundational, I would say core stock that pretty much anyone can own. Then I have Meta at number 3, where I think it gets a little riskier, but still has decent long-term potential. Then I have AbbVie at number 4, who I think is a fantastic biotech dividend, but it's going through a bit of a turnaround phase right now, coming off of the patent protection loss of Humira, so it's a little riskier because of that. And then I put the iShares ETF at number 5, which again, might be a decent choice for some people, but not really something that I'm interested in myself. But yeah, overall, I gotta say, I like these pickups here. I mean, 4 out of the 5 are stocks that I actually own large positions in myself, so I can't say anything negative about these. I think they're very solid pickups, and I've seen Ray Dalio make other moves in the past that I was not a big fan of, but these ones, I like these ones. I think these are all solid long-term stocks. But what do you all think? Do you like any of these? Do you agree with my ranking of them from best to worst? Let me know down there in the comment section. And is there any stocks that you guys haven't been picking up? Let me know down there as well. Thank you so much for stopping by, my friends. I hope you're all doing well. And I will catch you in the next video. Take care, everybody. Bye-bye.